In this video, guys, we're going to answer the question, should you stay away from stocks with a high short interest from an investment perspective? Hey traders, warm welcome to you, and investors, warm welcome to you. So my opinion on this, again, great question this is, should you stay away from stocks with a high short interest? So this is obviously someone who's looking at it from an investment perspective, i.e. long only perspective. And the idea is that, hey, if stocks have got a high short interest, i.e. when you go onto something like finviz.com or multiple other scanners and screeners, you can see how many people are short, or as a percentage of the float are short, the days to cover, and I've done videos to cover about all this terminology, but the important thing is there's a lot of people who have a short position on the stock. In other words, they are betting on the price of the stock going lower. Should you stay away from it as an investor? So there's some kind of yes and no. Yes, you should stay away. No, you shouldn't stay away. Reasons that I've put together, and also welcome yours in the comment section below, guys. Right, okay, so why you should stay away is it could indicate vulnerability. So at the end of the day, if there's a lot of people short on a stock, it generally means that the stock is vulnerable for some reason. It might be a funding issue. It might be that there's something coming up with funding. It might be that the business practices are poor. It might be that they're under severe pressure from competitors, and that might come out. It could be any number of things on the scale. Okay, it could be things that are so catastrophic to the company that causes it to go bankrupt. It could be things that people just perceive it's just not going to win anymore. Like I've seen, a lot of short pressure on high street retailers, for example, specifically in the UK and probably in the US as well, that just because people think that high street is dying, they get a lot of pressure from rising rents on the high street, specifically in the UK, rising rates, less footfall, a lot of this stuff's going online, and so that's a short based on a kind of a theory or a thesis, if you like, on a longer term play. Whereas something like a short on Tesla, at the time of this filming, is a play based on them just running out of funding, them not being able to do what they say they're going to do, or Elon Musk specifically not being able to do what it says it's going to do, the quality of the cars not being so good, and perhaps the bigger German manufacturers or GM or whatever, the bigger manufacturers catching up with the technology and making Tesla kind of obsolete in a small player. So that's a different kind of thing. One is like, oh, this is excessively overvalued and we think is very vulnerable to not being able to refinance, to all these other things, versus we just think that this company is going to struggle and is going to further decline. So it's worth kind of digging in and seeing why people are short, and kind of looking at some of the things on perhaps Seeking Alpha or something like that, where they talk about people who are cheerleading their short position, why that is. And you'll get to see then what the theory behind it is. So you've got to be careful how you look at it. But let's move on anyway. So activist pressure PR. So if you think back you might be aware of Herbalife. We had Bill Ackman, who was very, very vocal about his short position. He was hammering the PI, was spending a lot of money investigating it. It didn't ultimately work out for him at the time of this filming, but that's the sort of thing that you've got to be careful of, because if there's lots of negative PR and pressure and press, and there's activist work and stuff, and just causing a problem for the company, that might well divert the company's attention away from building stuff. It might divert investors' attention to it, and they might get jittery. So it's something to be cautious about. The other thing is, you really are trading against people who have got massive amount of resources in terms of money to throw at the research, and in terms of people power. Some of the brightest minds are working for these funds, and you're kind of saying, well, I think they're wrong and I'm right. And you've got to be a little bit careful of that. And I'm saying it cautiously, because it doesn't necessarily mean just because they've got lots of money and they've got lots of great people that are going to be right, but you've got to some way think, well, I'm basically making an investment based on the same information they've got, and I'm coming to a different conclusion. Now, yeah, we've got to kind of be confident with our investments and confident with our trades, but at the same time we've got to know our limitations and think, well, do they know something I don't? Is it something? So that's kind of the thing we've got to have in your mind, and that's in the yes column. Now in the no column, the biggest one is, well, let's just look at this one first. It could be hedges. It could be some kind of hedge. So in other words, some people could be playing a short, long play on, one stock versus another in the same sector, and that becomes a popular trade. Now, it may not necessarily mean that stock is vulnerable to downside. They may not necessarily think the business is that bad. They may just think it's going to underperform versus another one. So that's a possibility. Not so likely, but it's a possibility. So that's a reason why you don't have to look at it at all. Another reason why, and actually a positive why you might go to it, and lots of people, lots of investors and traders as well specifically, will be licking their lips at a high short interest. And I like high short interest from a trading perspective because of this, because it's fuel for upside. What does that mean? It means that if the price does start to rally and shorts recognize they're wrong, you know there's a lot of buying pressure that has to come on. Shorts are not generally very, very long term. They have to pay to hold it. It's something that costs them money, unlike owning stock, which pays you if it's paying a dividend. Shorts have to pay out that dividend. They have to pay also to borrow the stock. There's lots of costs involved in it. So you've got to be right. And if the price is going against you constantly, especially if it's really starting to go, kind of exponentially high, then it could be fuel for a lot of buying pressure coming in from those shorts covering their short positions by using a buy order. So that's something that might encourage you in, or some reason why not to. So the thing to look at, guys, is what is the vulnerability there? If you're aware of it and you still think that it's a nothing, then by all means. So just doing your due diligence and reading some of the articles and reading why people are short. If you still know the facts and you still decide to go long, then I think that's fine. I think you don't have to worry about that at all. And then you can say, well, actually, that might cause good stuff to the upside. It might cause pressure to the upside. So it's just looking at why people are short, understanding why people think the stock is not doing so well. Because one thing to point out, guys, is that very often people are shorting stuff and they've been shorting for a long time. It's also worth looking at the history of the short float, if you can do that. If the history of the short float has been there a long time and the price has been declining, that might actually be a bonus to you. I've seen a lot of stocks do this where they've been heavily shorted, the shorts have been proved right, the stock has come down, it's still got a thick short float to it, but now it's decreased massively since then. It becomes quite a good buying opportunity because the kind of short thesis has played out. And of course, with the short, the closer it goes to zero, the less money you make on a percentage basis, because you've made all the money from the kind of juice at the beginning. So as it gets to the downside, it gets to the low, shorts might start to cover because the risk reward ratio starts to change. If it's come from 100 down to 10, it's only got 10 more to go to zero. So they might look to a better risk reward trade out there. They might say, well, you know what, we've had the juice out of that, which could cause catalyst to the upside, fuel for the upside, as could actual turnaround of the company. So they may well be something that you look for. Like, okay, it's been short a long time on it, it's been beaten up, it's been hammered, the news is so bad, it don't seem to be doing very well. Maybe this is a turnaround play. Maybe that's exactly what you need to look for. Maybe it's something that draws you into it, as opposed to something that's, maybe in the news and it was very, very, lots of PR around it. It's all great and there's lots of kind of retail in it, but a lot of institutions are shorting it. Maybe that's something to be a little bit more cautious of, because those impacts on earnings might well be kind of 20% haircut, 30% haircut. So anyway, guys, those are my thoughts on should you stay away from stocks with a high short interest. Let me know your thoughts in the comment section below, and I'll see you in the next one. Bye bye.